All right, everybody, welcome back. So in this video, we're going to talk about options row. If you've gone through options education material so far, then you've likely covered things connected to the Greeks that include delta, gamma, vega, and now we've got rho. Out of all of the options Greeks, this one is the least significant and has absolutely no impact to your trading whatsoever. In fact, we wouldn't even discuss it at all other than you really kind of want to know that it exists. You want to understand what it is so that you can complete your options education and have a well-rounded understanding of each of the Greeks. In no way should you ever believe that rho is going to help you make a more informed decision about what option to trade or why you would want to trade that option. All right. So I just want to put that out there right away. We would apply rho the way that we would apply anything else. If we get a $1 move in delta, it changes the option. Well, if we get a 1 point change in the rates, we will see rho applied. Think about how FOMC generally goes and what the Fed generally does with rates. They move them at around a quarter of a point on average. Sometimes they hit us with an extreme half point increase. And if there's, some real economic uncertainty, if things are, going really bad out there, they may drop rates all the way to zero. But we're sitting at 4.5% now. So if we were to go to zero, it would be because there's something so extreme in the market environment, say like COVID, that they drop rates to zero and we get a 4 point drop overnight. That would be the most extreme scenario. Now think about what happened to the markets during COVID. Your concern was not options that were 2 years out in time and how they may be affected by rho. We had markets crashing, oil went below zero, everything was broken, and people were dying like crazy. That's how extreme it had to be to see those kind of changes in rates. If we want to apply rho, we need to understand how it is applied for calls and for puts. So on call options, rho is positive, and on put options, rho is negatives. So if interest rates are increasing, the call options increase. If interest rates are increasing, the put options are decreasing. Flip that over if rates are dropping. So if rates are dropping, call options are dropping. And if rates are dropping, put options are increasing. Okay. Now, when we apply all of that logic, we want to put it into a real world scenario, right? And I really thought this out because I've never once in all my years of trading ever considered what rho is doing to my option because it's completely insignificant. But I gamed out a real world scenario on how you could examine rho to benefit your trade. To do that, we need to first have an idea, what is the Fed doing right now? Are they in an interest rate hiking regime or are they in an interest rate cutting regime? In each of those scenarios, the Fed can pause along the way. So what they'll do generally when they're raising rates is they'll raise it 1 or 2 quarter of a point, and then they'll pause and they'll see how that affected the market. And then they'll announce another rate increase, a quarter a point or two, and then they'll pause again, right? So even if they're raising, they can still pause. Same thing in a rate cutting regime. They'll cut a couple quarters, then they'll pause, see how that affected the market. They'll cut a couple of more quarters and then they'll pause and see how that affected the market. The reason I'm laying all that out is because even when we're not necessarily raising or cutting, but we're paused, we're still in the backdrop of lowering rates or raising rates. And they will give that forward guidance and say things like, we're still looking to lower rates in the future. We're just not going to do it now. We're going to pause, right? Or they'll say, we're still looking to raise rates in the future. We're just not going to do it at this meeting, we're going to pause. So what are we doing right now with the Fed? Well, they're cutting rates and we're in a pause. So at the next meeting, which happens to be at the end of this month, January 29th, it's possible that they're going to pause again, kick the can down the road, and not lower rates. Even if they do lower rates, it's only going to be 0.25%. And the way that it works in the options world, if you think about, say, delta, when a $1 move is made, then delta is applied. But honestly, the market doesn't wait for the full dollar before applying the delta. It is applied every penny of movement all the way through that entire dollar. The same thing is applied when it comes to Rho. So I've got Apple here, and I went all the way out in time to January 15th, and we're looking at the 220 strike, which is just slightly in the money with a Rho of $2.07. Right? I'll just highlight that here. So with that in mind, if the Fed was to cut 0.25%, what could we expect that 0.25% to do to this one option? So if we have a January 15, 2027 Apple call option, and it's priced at $40 with a Rho of 208, if the risk-free interest rate decreases by 1.5%, the price of the call option would decrease by $3.10. Think about that. Not 0.25 point, not 0.5 point, but 1.5 points. And we would get a $3 change in the price of that option. So instead of the option being $40, it would be $36.89. And if we wanted an extreme example, if some really bad stuff happens in the world, say COVID again, and they drop interest rates all the way to zero with a Rho of 208 and an option priced at $40, that option would drop $9.31, giving it a new price of $30.68. That's pretty extreme, right? And you may be thinking, come on, Sig, that's almost a $10 move in the option. I would want to know that. I get it, but think about the idea that if we had a COVID style event, that the price of Apple would drop significantly anyways, and the calls would be demolished anyways because of the drop in the stock, right? If you go back and you look at what happened to Apple, for an example, way back during COVID, which we're going to do that now, we'll just put this on a monthly chart and we can go back to 2020. There's the COVID drop where Apple was at 82 and it dropped down to 52. That's 30 points that it dropped, right? That it dropped a lot. So we got to keep that in mind when we think about the idea that interest rates could change the price of the option drastically enough to impact your trade. Plus, look at how far out in time I had to go to even find a high Rho. If we're trading, in the front end, the way swing traders would trade, less than 60 days to expiration. So here's 59 days right here in March, and we've got a Rho of 15 cents. Well, between now and the next 59 days, we've got one FOMC meeting, and it's likely that they're going to punt or not decrease rates at all. And even if they do, they're only going to decrease it 0.25 point, and 0.25 point would make almost no impact to that options price. Once we apply things like time, volatility, the price of Apple moving up and down, earnings, Rho will have almost no impact whatsoever. If we're thinking about leaps, which does get us into longer term trading in options, and if you're thinking about how Rho would affect you as an options leap trader, then you really want to consider what the Fed is doing. And you should be considering that anyways, because if the Fed is raising or lowering rates consecutively or consistently, you really want to know if you should be in growth versus value to begin with. But suppose that we are seeing rates consistently be lowered by the Fed. So we're in that regime. Growth should do better than value, and a decreasing rate would hurt calls. It would help puts. That doesn't sound good if we want to go out and sell puts and buy calls. We're going to have to pay that tax. That's the way I would look at it, as a tax. But that would be if we're focused on growth stocks to begin with. If we went and focused on value, which likely doesn't do good when the Fed is lowering rates, then we could focus on how those stocks would perform. We may want to sell calls and buy puts, and in that environment, we may do better, right? So let's think about it from that point of view. With call options, rho is generally positive. So when they're raising rates, the calls improve. When they're cutting rates, the calls suffer. Well, when they're lowering rates, calls are going to be negative and puts are going to be positive. Well, when they're lowering rates, growth stocks do good and value stocks generally don't do so good. So we would want to buy puts anyways, and the puts will benefit from the impact of rho. That is the best real world example that I could come up with to try to help you understand or to help you apply rho in your trading. I've never used it for anything. I don't know anybody who ever does use it for anything. And we're talking some of the biggest options players in the market, right? The most well-known, most intelligent groups of traders that I've ever come across. Nobody uses rho. So hopefully this video has really broadened your horizon about what rho is, how it, in theory, can affect an options price, and hopefully it gives you some comfort in knowing that you're not missing anything. You don't have to worry. You don't have to be concerned about not understanding this Greek because it just won't be applied in the trading environment. That's what I got for you guys. I'll see you at the next one.